All right, well, welcome everybody to the 11th episode of NAAIM Confidential. Today we have a very special guest, NAAIM's president, Ryan Redfern. He is the chief investment officer over at Shadowridge Asset Management. So I'm excited to hear what you have to say today. And I know you only had about a few hours to get ready for this on last notice. So hopefully we have a good amount of stuff to cover. And I think first off, let's go over the NAIM Exposure Index.
Absolutely, absolutely. I will share that. I've got it ready for you. Boom. Yeah, thanks
It's
for
nice
having me.
having
And
somebody
very
have the exposure index ready.
absolutely,
Well,
absolutely.
I was looking at the numbers. I like to compare last week to this week, and I noticed we did take a little bit of a drop from, let's see, it was 104.75 to 93.22. And interestingly enough, that was almost exactly what it was 2 weeks ago. So we're
Mhm.
back at 93 and we were there around 2 weeks ago. But not too much of a change there. That was, about 10%, nothing crazy like we've seen it sometimes. But what are your thoughts on the dial back and exposure there?
I think it's interesting because I've reported the same number for like 4 weeks in a row. We're like 85%. So it's not me doing the volatility. I don't know who else is. Maybe it's you, but
It's not us over here. We've had the same, at least the one that we use for the exposure has stayed the same. One of our other ones has dial back exposure a little bit.
sure.
But that's the beauty of having all these name members in here. We don't know who's driving the
Right.
numbers which way.
Right. And there's been a lot of comments about that last week's 100 plus reading. I've seen several other websites make commentary on it. I think it's really funny. It's getting a lot of attention. So I think that's great for name.
That's good to hear because I didn't catch the one last week right on time, but when I was reviewing this week, I'm like, wait, we were over 100 last week. That's very interesting.
Mhm.
So, I mean, I'm just looking at that chart. It looks like there was maybe two other instances in the last year that we've bumped over the 100 mark. So it doesn't
Yeah.
hasn't happened that often, at least recently.
Right, right. And one of the comments was from ElliotWave.com, I think, and they said typically when these get this high, they were calling it for a reversal. Jay Capel had other commentary, but less about it being a reversal, more just it could be a continuation. So the bottoms tend to be more of the reversal points from what I've seen, the research that's been done. But either way, it's a high number. We're all very, very invested right now. So it's hard to fight a
Definitely.
bull market. It's hard to fight a market that's running.
It is. It is. And we had a pretty decent week this week as well.
Mhm.
So, yeah. Well, there it is, the name exposure index. I think next up, I was looking at kind of the slides that you had, and you want to jump into kind of your overall investment philosophy and maybe what you're seeing out there in the markets right now.
Yeah, sure, sure. I very quickly, as you said, I only had a couple hours to throw this together, so I hope it works. But I kind of thought of it as a few of my favorite things, and we'll go from there. But
Perfect.
first, of course, we have the disclaimers. This is not this is for educational purposes only. This is not investment advice, all that kind of fun stuff. But I will dive into specifics because I like to. But no, it's not a recommendation. So yeah, so one of the first things that I love to look at is the relative rotation. That's one of my, absolute favorite things from Julius de Kempener. He created this. It's a chart of both momentum and relative strength on one chart. So it kind of goes, let me grab this little pen, the laser pointer. Here we go. You can see that. Right. So things, I kind of call it ducks swimming around the pond, right? From leading to weakening to lagging to improving. And these are showing all the S&P sectors versus the S&P index itself. So you can see which leading and what's lagging, right? So this week, real estate is definitely on its way out and lagging. Energy's been strong. Communications have been strong, and then everything else is kind of mixed. But it gives you a good sense of where things are shifting in the market. But I also like to take this a step further and look at it versus T-bills. So it really looking at all of the S&P sectors and saying, okay, versus the risk-free rate, old school kind of thinking, conventional thinking, and then making it technical, and then going, okay, where are the strong parts of the market, and what are the sectors as a whole? How are they driving market movement? And if they're all starting rotating up in this leading to weakening, it's not a bad place for the market. But typically, when they all start rolling over into this lagging box, then you start to go, okay, something's up, and a sell-off is probably on its way. But it can't seem to get there, and it's fascinating because it's much more natural to watch these do a big circle around the pond And you have a weak market, you have a pullback, you have a strong market, you have a run up, you have a weak market pullback. It's back and forth and back and forth. But we've just been like bouncing right in here in this doing little circles right here. And it's been like that for weeks, which is just very different. And that's one of the things I think about relative rotation. Yeah.
So, out of curiosity, when was the last time that you saw it moving a little bit more into the lagging and improving area over there?
January. There was
January?
a very decisively right at the peak of, I think that's when the sell-off started in January, the first day, and it only lasted a week. But it was very evident from the cycles and watching them go around the chart. That's what I got there on relative rotation. That's something I look at every day. I also post it on Twitter every week, so it's worth, if you want to follow those along without paying for the charts, you can flip through my Twitter. You'll get the history, and it is fun to watch because you can see like week by week by week, and I have a little comment on what's happening, and so frequently I'm like, oh look, they're all going into lagging. Look, the market sells off, and it just kind of works again and again and again. So it's just a neat thing to watch. I don't necessarily trade off of it, but it's certainly a great heads up to know what market context, knowing that where we are and how you should be thinking about where we're going to go next. So, all right, I'll move on to another factor that I really like is the advanced decline line, and this is actually my own version of it. It's the cumulative advanced decline with the 55-day and the 21-day, and I started using this probably 2015, 2016. Really just with the 55-day. And the only thing I really cared about was it above or below? And really was that, for me, that was should I have leverage on or not leverage on? And that's really just all I used it for. But I've been using it ever since, and it's really worth a note. Though lately, this 21 has been a much more interesting and relevant factor, the 21 moving average there versus the big 55, which is the old school. But like always, when it's below the 55 and it's hanging out there, we're probably not in a strong market. Because it crossed over here, early, a week into November, and then it's been great ever since. It's kind of like I don't fight money flow. If the money wants to come into the market, it's dumb to fight against that. So there's a couple different ways to grab at that. I just find it useful. Yeah,
I think Jim was kind of talking about that a little bit last week. I remember hearing a blurb from the presentation he had.
Yeah, and he does a lot. He does a lot on cycles. He does a lot on money flow. I'm going to do some seasonality stuff at the end here. That's very, very Jim Lee inspired. And I certainly, I think I said on that one. I do a lot more of that thinking because of him, because of things I've seen him do. I mean, to have your whole calendar year trades mapped out in December, that's wild to me, and it works for him. It's the craziest thing. But I love seeing outside the box thinking like that. So
that's what I love about NAAIM. I mean, because I know with our business, when we came in with a certain philosophy, and then we were able to like talk to other NAAIM members there, and we're a family business. So my father was able to learn from a lot of other people in the NAAIM group, and just they were very open to sharing some ideas and collaborating and kind of expanding your knowledge there, which is, I mean, you just point out to a perfect instance of where NAAIM brought that value.
Oh, absolutely. And I can name so many NAAIM members that I've gotten something from. Rob Bernstein's how he trades bonds is amazing. And that's why I had him on when I was the host. It's so simple, but I would never think to come at it the way he does. Another great example. So yeah. And even Matt Spangler does bonds in a neat way. If you've seen his, I think he covered it in his episode.
Yes, I do remember that.
There's so many ways to come at this stuff, even if we're all looking at the same charts. I love getting other ideas and expanding my own thinking. So I'm not stuck in a box or
definitely
like you get. Cool. Well, so once you have market context, I'll move on. Is to think about what's strong, because I think I'm not a fan of diversification in that I find owning the weak stuff just because you have to is the dumbest investment philosophy that I see of most typical advisors. I have to own small cap. Small cap sucks. Why would you own it? I mean, why? It makes no sense to me. So I'm always looking at a lot of ratios between small and large, and I've got value and growth on this screen and every which way, and knowing where's the strength and where's the weakness. This example is the 5 and the 21 day. So I think of that as 1 week versus 1 month. On the time frame to the moving averages, and then getting a feel for where that's going. And I have big obvious arrows to make me realize what's happening. I like to be obvious on my charts. So if this is moving downwards, growth is going to beat value. it's been a little sketchy here, but it's winning again, at least with the IVE versus IVW ratio. But I find ratios super useful of helping you stay on the right side of where strength is. And then you pair that with RRG, and then you can start doing that with sectors. There's a lot of neat ways you can. This stuff builds on itself to get you in a good place strategy wise.
Every time I think of investing, and I always like to think of it in a really simple way. I'm thinking like, oh, it's like you got one Lego here, you got one Lego here. You're building it up to your full your full set, your spaceship, whatever you're building at the time. So, but it's always about finding which Legos fit together. And that's what you have to do in investing, because not all of them do fit when you're trying to put them together, and they might turn into just a complete random mess that my son would make, at under 2 years old. So
I love that. See, now I'm going to picture building a spaceship, because Ben said to every time I'm putting these together, I'm building my Lego spaceship.
Exactly. Yep. It's what I do. I like to think of things like just kind of have like a metaphor or some other way to think about simplifying what I'm looking at.
Right.
That's big for me. I like simplifying things to a degree. So
yeah. Well, we can, as you know, we can take this stuff way too far and analyze it. But really, at the end of the day, the simple stuff that's systematic, that works, is the most effective, especially the stuff that you can execute without question, right? I find I wanted to tie in psychology to this, but it's if you have a strategy that doesn't resonate with you personally as the manager or the person pushing the buttons, it really doesn't work. Even if you have a great strategy, I've given people the best things that I knew how to do, and they're like, "This doesn't work." I'm like, "It works great for me," but there's a part of where the person has to understand and really believe what they're doing to make these trades based on this information. So what goes on your head is just as important as what you're looking at on the charts. And the simpler, as you say, the easier to convey, the easier to understand. There's a lot of noise that we can create in here that's unnecessary to still do a good job being technical.
definitely. I know one thing that's always come to mind. I might have mentioned this before, but um, we like to keep things simple around the scarecrow side. Like if something's working, we don't want to try to go out and figure out how to make it a little bit better every single time. We might do a little bit of that, but you can get caught up so much trying to over optimize whatever your strategy is. And then you end up over optimizing out of the success that it had. And so it kind of goes back to that simplifying aspect that we're talking about.
Right. Yeah. And you've got to let your strategies breathe a little bit. I've seen them, you can really narrow it down. And then at the end, the signals are too many. And it doesn't do what it was meant to do when you set out. Sometimes breathing room helps as well. Cool. Well, cool. I'll dive in. My last two slides are really about seasonality. SeasonX did a webinar for NAAIM last fall. I just thought it was really cool. I actually met them at the CMT conference in New York last year. I love thinking about seasonality personally. And the more I see people like Jim Lee using these kinds of ideas, I'm like, okay, there's something here that's I've got to pay attention to, at least for context. So this chart is the last 96 years, taking only the election years from the S&P, and then how that year turned out, right? So typically not much happens until really end of May. Usually the sell in May point is here. That's usually the peak you would expect to by the market lore, but really that's where the bottom is, and it runs up until early September. Historically, does it always happen? No, nothing always happens. But what I find with seasonality is when that backs up against and agrees with a trend that I'm looking at, I'm like, okay, I'm all in on this trend. I may even go with leverage because I've got a good confirmation that's not technical. It's kind of coming out of somewhere completely different. So I find that very useful as a secondary thing. I've used seasonality to short bonds for a couple of weeks just because I saw a weak little thing here, and it's great. Last year I used it to short emerging markets as a hedge during the sell-off, because this is pretty typical. And next slide I'll show a typical year of the last 10 years. It's a little more up and down. And this does include COVID, right? So here to here, you gotta jump. But there was actually a similar thing on the 10-year treasury that was it's down 100% of the time from the 15th to the 30th. And like, that sounds like a good trade. And the charts were kind of backing it up. I'm like, okay, we're a little overbought here. What could happen? beautiful. When seasonality and your technicals match, I'm just like, it's happened. That's where the magic happens for me. And the more I do this and the more I'm seeing that happen, it's hard not to incorporate seasonality into your analysis.
That is you've now piqued my interest now with Season X here. I've never I missed that one, and now I feel like I need to dig into this a little bit more because seasonality stuff, especially with talking with Jim as well, has always sparked my interest. And if you're sparking my interest, that's big because I don't dig into the graphs as much as some may think at times. I have a higher level understanding of how things work together and the building blocks there, but like digging into the nitty gritty is not always my thing. Sometimes I can do it. I love math, but this is now interesting me. So you've sparked my interest.
Nice, nice. Well, again, it's always worth noting. I mean, September is almost always down. I mean, right from the September 1st to September 30th. That's not a good time to be in the market. And if your technicals back that up, you probably want to be against it or even short it because there's so low probability of something good happening from here to here, right? And then there's a super high probability of the market going up from around there to around there. What I found interesting is doing some history on this is before about 20 years ago, the bottom used to be right around the last week of October. And really since the 2008 crash, that's been moving earlier and earlier. Typically it's around the 15th or even sometimes the 1st of October. Now this past year, 2023, it did actually coincide more to there than it did to the earlier ones. But it's certainly worth noting that these things do shift over time, right? So the change, I might go, oh, I'm ready to go all in here because that could be a bottom. Well, maybe, but I want to wait till my other technical indicators say, hey, okay, they agree. It's time to turn. We're seeing money flow change. We're seeing the technicals change, whatever indicators you like to use. When that starts agreeing, then I'm like, great, because we really it was tough to get in here last year. And it was like this. It was a jump and then a move lower, then a jump and a move kind of to the same. But once we hit that November 1, it was just off to the races. And if you weren't there right away, you probably missed a lot of the move because it happened so quickly. But looking at seasonality, I was like, well, look, I know it's coming. I just don't know when exactly. But I've got an inkling it's going to be within these next few days. So I find that hugely, hugely beneficial. And then even December last year, we did not get this sell-off. It just kept running, which I thought was interesting because we kind of lightened up once we got there going, that was the move. I didn't expect it to keep going to January and then February. And now how far into March are we? We're still just kind of going. I mean, money, I'm still invested, but I'm not all in super aggressive anymore. But I also got what I wanted out of that move. So there's always trade-offs.
True. I mean, I'm trying to think of, I'm taking that all in right now because I was thinking about what we were doing at our end around that October timeframe, and two of our systems were completely different. One of them kind of rode through it, and so it caught all of the long. The other system was going to cash multiple times during increasing its cash exposure during that October timeframe, but then didn't catch all of the November because it came in a little bit later, like mid-November.
Right.
So you can catch all the recovery there. Also didn't take on all the drawdown there either in October. No. So it was a little bit of a trade-off.
Sure. But again, the drawdowns were really in September. Even, go back to August,
True.
September. October was more just messy sideways. We did go down more than up, but that wasn't where the meat of the sell-off was. Right. That happened earlier. So I just find this to be useful to confirm other things that I'm thinking about. Certainly looking forward to I was hoping they'd get more of a drawdown of here, but of course the COVID crash is really what helps influence this. You can actually take it out with this software, but it's still a down move, just not as drastic. It does actually kind of grind down until about mid-May, and then it runs up. But certainly interesting when you look at the factor of COVID in there as well. Also, kind of from that webinar with them, is they talked about 10 years being a key factor, of the most relevant time frame, because you can look at on here they have 95 years of the S&P. That's great, but stuff that happened in the 20s and 30s and 40s, some of it still happens and some of it doesn't. So, kind of understanding and I feel like that's recency bias, but it's but
Yeah.
it's also recency. There's a benefit to that too, to understand what's happening now versus what happened then. Because you can go back and look and see the things changed. The way that the markets moved, it was similar, as they say, it rhymed, but it's not the same. So you kind of this helps you kind of get a understanding for how things have shifted. And you can actually go to 5 years as well, but I find this 10, as they kind of said, the developers of the software said 10 years is kind of the sweet spot for looking back of on seasonality.
Okay. No, that's good to know. I can definitely see that with, going back the whole 98 years and 5 being too short because I feel like that
Yeah,
could definitely just be a little bit too recent, not have enough in there.
right, right. And you can screen out, crazy years. You can just remove 2020 from the chart, and you can just election years. You can do all kinds of straight crazy stuff, including like moon cycles. You can throw into there, and it's full moons and new moons. It's wild when you really dive into this stuff. How many factors are in there, and how many cycles? Actually, there's something to so many of these cycles that it's really worth. Again, going back to Jim Lee, if he hadn't pointed me out this, I'm going like, you start to see stuff, right? When somebody, when you're shopping for a certain kind of car, you suddenly see that car everywhere. I'm like, oh, I'm now seeing cycles in this. I'm like, oh, there's something there. I really have to pay attention to it. So that's really where that brought me. So I love sharing it because I think this is so relevant and so useful, and it's something that not enough people really know about. So
No,
maybe I'm
that's really
ruining it
cool.
by
And I like,
sharing it.
yeah, and I like that you can change like whatever you're thinking, like you said, moon cycles. I mean, whatever it is, you can pick those years and
Mhm.
see how the impact of that on the chart really quick.
Yeah, absolutely, absolutely. I should ask them about eclipses since that's relevant,
Right.
relevant this year, and we'll see where that goes. So,
Is there
but yeah,
anything
that's
with leap year? No, just kidding.
oh, that's a great question. I bet you can. Well, I mean, it's every 4 years, so
Yeah.
you can certainly screen for that. It's basically the same as the election year chart.
Right. True.
Oh, that's ominous.
Hmm. That got me wondering.
No, no,
Yeah.
it's all good.
I might message you after this. I want to know a little bit more about this. This piqued my interest.
Yeah, absolutely, absolutely. I try to post these on Twitter as well if something interesting is happening or something is fun to look at. I mean, I've actually done a whole 4 seasons thing with the bond market that I find very, very useful. And the probabilities of being, positive for this little grouping is like 80%, and then it's 100% likely it's going to be down from here to here, and even tells you like how far, what to expect. So I'm trying to develop like a seasonality thing, going, oh, this is the springtime for bonds, you should be in them, and this is fall, and you might want to back out. There, yeah, there's so much in the seasonality world that you can really spend time on that I really think it's worth a look if you haven't done it. Not just you, but the listeners watching. Hopefully, somebody
Yeah.
else.
Oh, yeah.
But it's cool stuff. Yeah. No,
Yeah. So, what is your favorite investment quote?
my favorite investment quote is actually, I believe it's from the Market Wizards book, and this has always stuck with me forever. And it's, you don't trade the markets, you trade your beliefs about the markets. And that really goes to that psychology thing again. If my beliefs are messed up, I'm probably not going to trade very well, even if I have a great system. So I really, really think about that a lot. Making sure my head's right, and I'm in a good place when I'm developing strategies, when I'm thinking about trading, when I'm doing all this stuff that I have to do for clients. Because some of us manage a decent amount of money, and you really have to be responsible about that. You also have to keep yourself in check and make sure you're not doing something irresponsible because your mental game is off that week, that month, that year. And it's tough because market psychology can really mess with you. A really bad market can do things to you. Or having clients calling you saying, "Hey, why are we going down?" It's like, I mean, we're not going down as much, but it's still down. We all feel it, and that can translate into how you think about the strategy. So you really have to separate that stuff.
That's a big topic, and that's a topic that was big on my mind during COVID because when I joined Scarecrow, 2015, I didn't really have like a huge
Mhm.
like very scary market condition that I was like, whoa, I can reference like 2008. Like I was around them, but I wasn't working in the industry. So when that came around, it was very I was almost looking forward to it because it kind of taught me the other side of the business and what it was like in those downtimes. And I wanted to see if I prepared myself um, to deal with that from an emotional standpoint. And Yeah, I mean, there were times I remember looking at like what our strategies were doing and where my head was, and I'm like, I can't believe you're. I remember when we went back in, and it was like pretty. It was kind of right in that beginning of April, and I was sitting there like, I don't know. I just
Yeah.
can't. I can't do this, but I'm going to follow the system. And it turned out being a really good decision. But it was interesting to see how different my opinion was versus or my feelings were versus like
Mhm.
what where the strategy was, and not allowing that to make a big impact in it. Because at least on we believe in following the strategy that we have and not overriding the system. There are some different beliefs on that, but we that was kind of our philosophy. And I was like, dang, am I going to be able to do this if I have client A, B, and C calling me?
Yeah. No, it's tough when you're pushing that button and it's, 10, $20 million you're putting in the market just like that at a
Yep.
push of a button. I mean, that's a big responsibility and you feel it. You absolutely
Oh, yeah.
feel it. I feel it every time, even still. Even when I know it's a good decision, it's tough. It's not the easiest thing. So keeping yourself in check is absolutely a big part of it.
Definitely. And it reminds me of the speaker we had at the NAAIM conference last year, which was I think I'm more on like the client side of like not letting all the news go in and impact the way that they're thinking about the market and then bringing that to you and then causing that fiasco in there. Um, but it was I remember that one was very interesting to me, just all the noise that you can have. And I think you kind of talked about this and making sure that you find what your philosophy is and what you're sticking to, and then, only bringing in the extra noise if it's like, oh, Jim bringing up a new way to look at seasonality stuff or, and so on from there, but not letting, everybody's opinion or every come in there and impact what you're doing. Because that's when I think things can get a little bit crazy. Because then going to this quote, you're not really trading your beliefs, you're trading everybody's beliefs in with your beliefs.
Right. No, you have to watch out for that. It's
Yeah.
definitely a big part of the game that people don't realize. You think I can just get this quick indicator and that'll make all the money for me, and it's so much more than that. All right.
Well,
Oh yeah.
perfect.
And
Well,
there's my contact. If you need it, Ryan at Shadowridge Invest. Definitely follow me on Twitter if you can. Ryan Redfern CMT. It's a good way to follow me, see seasonality and relative rotation charts. Post those all the time.
perfect. Well, thank you so much again, Ryan, for coming on here. And we will catch everybody at the next Name Confidential next Friday.
Awesome. Thanks for having me.